All right, this is the video that I'm finally going to go over kind of how I trade. So we need to recap, okay, that when I kind of talked about fair value gaps, the idea is kind of looking for some sort of sell side, whether it be equal lows, equal highs, London lows, London highs, some sort of sell side. And to recap, we might not always know how we're going to react to it. Like if we just do this and we don't really get any market structure shift, there's probably some sort of sell side we're probably missing lower, which is fine. We just don't take a setup here. But if you ever see us come down to a sell side and you see the kind of like a very wicky reaction off it and we instantly kind of pump back up, chances are we're probably going to go higher. So what do? Well, you look for a fair value gap. Maybe it's in discount of the leg. Okay, maybe it's in discount. Maybe it's not. Maybe it's like this, and you take along in that fair value gap again, and this is kind of your model. So this is the basic model. Now, that's actually not how I trade, but that's how people start trading, how I talk about. Okay, and that's fine. This is fine. I just don't trade that way. I don't prefer it. Um, excuse me. What I do is I trade inverse fair value gap. So I wait for them to be broken. And I just think it's much more higher probability than this because it takes a lot of you need to be really good to take setups like this, like really good, really know the draw on liquidity. The reason why I like inverse fair value gaps is because sometimes if I'm wrong, I'm still gonna bank. Okay, if that makes sense. So what I do is I actually don't take the setup. I wait to see if the fair value gaps gets broken, and then I take kind of the short setup here. So that's what I do. So how do I actually use this along with sell side and buy side and all that? Well, what I do is if we ever hit sell side or something and we have a bearish fair value gap here. Now, because people don't pay attention and because people don't really understand what a bearish gap is, what they're going to do is, and actually it's not that, it's people don't understand how to read liquidity. People are like, oh, there's a bearish fair value gap here. We must reject it. And you can see, here's an example right here. See this bearish fair value gap? Why don't we reject it? Because of liquidity. We've already made such a big move down. It already swept this major low. So why in the world would you see us reject this fair value gap? And for the people who are like, oh, I've seen us reject a fair value gap like that before, that's fine. It's just not a trade you typically take that's a good setup. And if we do reject this gap, there's probably some sort of sell side you're missing below that's just more to the left of your chart. But anyways, you wouldn't short a gap like this. But most new traders are not going to know that because they don't pay attention. They don't know where liquidity is. They don't think with their brain. And with my brain, all I see here is big leg down, way too short to short, way too low to short, and we swept the low. Why in the world would this fair value gap be rejected? It shouldn't. So what I do for my model is I kind of wait for a singular obvious gap, something that the classic new trader is going to see with their naked eye very, very easily. I think this would qualify as one. Someone's clearly going to see this and they're going to short it. So I kind of wait for that to form. And if we think about it, if there's a bunch of algorithms who create this candle, because you know retail traders aren't going to create a candle like this, it's just too massive. There's a bunch of algorithms creating this candle, an institutional candle. What do you think is going to happen when we go back above it? Well, all these orders that create this candle are probably going to get stopped out because that's how the market moves. So I kind of like what I do is I wait for us to hit some sort of sell side. And again, you might not always know the reaction off a sell side, but and that's if we hit that sell side and then just instantly pop back up over that bearish gap and the body, keep in mind, say the body closes above it, that's my sign to long. Now, in the beginning of the boot camp, I basically said bodies are going to be the most important thing you want to pay attention to because I use bodies all the time. Wicks do the damage, but bodies are going to be more confident. And ideally, if you're taking a fair value gap that gets broken, you want to wait for the close over. So you can kind of see these two wicks here kind of wick over, but you ideally want to wait for us to close over. It's more of like a concrete confirmation sign. So you're probably wondering what time frame do I use? I use the 1 to 5 minute time frame for entries and then the 15 and above just for bias only. I do not use the 15 and above for entries. So this is my model. Um, Now, if there's ever two fair value gaps, let's say there's two bearish gaps in a row here, okay? So it looks like this maybe. You can still take the trade, but it's not going to be as smooth because we could literally go to this gap here, or we could even go down further, and there's not really an easy way to enter. So your risk is going to be kind of if the body closes below both of those gaps. Now, you're probably wondering why it closed below. Because if you go study and backtest inverse fair value gaps, most of the time we close above them, we will actually not get a close back under them if you're right. And most of the time we do close back below, we're just going to go and hit the low lower. So what I do is I kind of calculate my risk. I kind of do like 75% of what I would actually risk. And then if we do get like a really bad close, maybe we close down here, I just kind of get out. But sometimes it's actually you risk less than you think because we'll get like a close here, but your stop loss will maybe be here. I would not suggest doing a hard stop loss here, but you could do the low if you wanted, but it's just going to make your risk reward a lot worse, as you can see. And again, if you go back test inverse fair value gaps, or in other words, IFVGs, a lot of times you're going to actually realize that if we close back below, we're probably going to go lower. So it saves yourself some money. Now, going back to what I've said before, you ideally do not want there to be two fair value gaps here because the risk is going to be much wider than if there was kind of one fair value gap here. So you can kind of see this would be a little tighter, and that's kind of what you do. Now, as long as the risk is fine, I actually enter in the market close. I do not wait for a retest because I find myself missing trades sometimes. If the candle is a very big close, I will wait for the retest, but not typically. It's up to you what you want to do, and this is where you're going to have to back test. So on this close right here, I'll get in right on the close. I will not wait for the retrace. And in this example happens to retrace, but like what if it didn't? And then that's how I kind of get in. I kind of guesstimate my stop loss somewhere around here, and I risk 75% of what I would usually do. So I'd take off 12.5% risk. That's what I do. So it's actually evens out to like 88%. So if I want to risk $200 in a 50K account, I'll actually only risk like 175 just in case the stop loss is more than I expect. Okay, so that's kind of how I do my stop loss. But I'm looking for the same model that you all look for, the 2022 model, except I'm making sure there's an inverse fair value gap or bearish fair value gap that gets broken in the process to take a long setup. Okay, so that's important to note. Now, why do I like a singular fair value gap? Why not two? Well, if there's going to be two, the risk might be a little wider because you're going to have your stop below both of these gaps. Because like I said, if the market's bullish, we could go to this one and then bounce. It doesn't have to be this one. Now, sometimes if there's two, you can actually, what you're going to do is, what if this is the 1 minute time frame, but you see two gaps? Well, you can check the 2 minute time frame to see if there's actually a singular gap, okay? And this is what I do. And then I'll just end up using the 2 minute. So this is the 1 minute time frame. Let's see. There is a tiny gap here, but it's not obvious enough for the naked eye to recognize, so it doesn't really matter to me that much. This is the more obvious singular one. So if I go to the 2 minute, the 2 minute has a more obvious gap here. And us breaking this 2 minute or closing above this 2 minute tells me we're going to go at least to the higher gap here. So if we know the market targets highs, lows, and inefficiencies, I know the close above this 2 minute gap is at least going to target this gap here. Now, the problem with this one is this candle closes above this. This candle actually closes above this and hits it at the same time. So actually, this would not be a valid trade, okay? And yeah, you can kind of see how it works. So in this example, we have two gaps here. We have this one and we have this one. So what would you do in this situation? Well, you'd have to wait for the last one to break, because if we broke this one, what if we rejected this one? That's the logic I think with. So I had to wait for both of them to break to tell me we're going higher. And you can see we end up closing above this one. We retest it. And you can actually see we come up to this tiny, tiny gap up here. And this makes totally complete sense, because this gap tells me we're going to go to the next high or the next inefficiency. So the next high is here, and the next fair value gap or inefficiency is right here. So I at least know we're going to go to here, okay, which may allow me to move my stop to break even. I at least know we're going to go there. So the risk reward won't be the greatest, but you can see the logic and how the market moves here. So That's kind of that. So let's go over another example. Here, this is actually, I actually called that one earlier. So here's a bearish gap right here. Okay. Um, and we get a very strong high momentum candle closing over this bearish gap. So I said on my channel, I said, tape read this, right? I kind of drew it out. I said tape read it. I called it a live time. Tape read means either you can tape read or you can take the setup. I don't care. But you kind of tape read it. So this was actually the 3-minute chart. And I said tape read it. And this is kind of the risk reward I drew right here, which ended up working. And then we also, if you go to the 30-second, which you'll probably think I'm crazy for going to the 30-second, but you will when you get good, trust me. 30-second time frame is very good. You can see there's another bearish gap. Now, think in terms of common sense. How many people do you think are going to short this because they're like, oh my God, very bearish candle. Now we got a bearish gap. ICT told me to short this. Probably a lot. That's where I come in. I kind of wait just to be sure. I wait for it to be broken. And if it is, sometimes it isn't broken, just depends. And then I take my long setup. So you can see one of my executions earlier was in trade recaps. You can see I longed this inverse fair value gap when it kind of broke or closed below or above. And I just targeted the next high. And that's what I did. So you can see those in my executions. And I just targeted the next like decent high, which was this, what happened to be here. You could target higher, you could target lower. I had to go, and I was already kind of pretty green for the day, so I probably should have targeted it like this high and then this high. But you're gonna learn that through screen time. I couldn't really hold the trade. I was busy, but that was that. So on the 3-minute time frame here, we broke a 3-minute bearish gap, which a lot of people probably shorted. We come down, retest it, and this is when I said tape read this long setup, and we get a 30-second re-entry. So we kind of have two very nice entries here, and they both work nicely because I know the majority of the people are going to be shorting a gap like this, so I kind of wait for it to break. Now, why is this gap so good? Why wouldn't I use like a, let's say, why wouldn't I use a gap like this for a long entry? Well, to me, this gap isn't as obvious. And also, two, we already kind of hit the high right here. So you can see the candle closes above it, but also hits the high that this gap was created on. And this magical, the reason why this strategy is so good is because an inverse fair value gap tells you we're for certain or 90% certain we're going to the next high. And I can't say now that, oh, we close above this. I can't say we're 90% certain to go to the next high because we already hit the high. So here in this example, the high was here. So in this example, I could say, okay, when this gets inverse or when this gets closed above, we're 90% certain we're going to go to this next high, which allows you to, one, move yourself to break even, or two, take some profits off. But in this example here, one, this is kind of too far left, where this is kind of just right there. It's just kind of formed, and we just kind of break it right away. And that's that. You can see another example. This is another 30-second trade. Another 30-second bearish gap. It's singular. We kind of swept the low to the left, which is the most important part. A lot of people think, oh, it's a bearish fair value gap. It's inverse. You have to use these with context. I'm telling you, you have to use these context. I mean, we clearly swept some lows. We swept this low, this low. Didn't really get much displacement. Now, do I know we're actually going to sweep these lows right here? No, I have no idea. I see this. Do I know we're going to inverse this fair value gap? No, I have no idea. But when we do, it's like, okay, well, we swept these lows now in hindsight. Didn't really displace below them. I now know this is probably going to be a decent long setup. And you can see it goes like a decent, goes up to these little tiny equal highs that we kind of got here. See these two equal highs? And then we just dump. But you can still see how like impactful it is in the market. And you can see this is just a clean signature in price because it's singular, it's big, it's obvious to the naked eye, and people are going to short it. Okay, so you can kind of see how it works there. Now let's look for another one. All right, let's look for like a bad example. All of these would be bad examples. Okay, because there's too many. There's not a signature in price which is clean here. It has to be singular. There's just too many here. It's not something I'd use. I wouldn't just be like, oh, I'm going to use this one. It's just not a clean signature in price, and you're going to learn that. I post these best inverse for every alley gap post of the week threads on Twitter every Saturday morning. I suggest subscribing to my Twitter and turning on notifications for that. But even like throughout the day, I'll post some. But this one was good because in this singular leg, we had a singular bearish gap where a lot of noobs or new people are probably going to short it because people think we're going to reject the fair value gap, which is not always the case. So when this closes above, you can see this candle closes above, I'm almost certain we're going to go back to the high, which allows me to, one, either take some profit or just move south to break even and target higher. So you can kind of see I kind of got in here before the retracement, and I did call this entry on a stream. So fair value gap's very nice because if your bias is truly wrong and we do go back to the lows, let's say this were to happen, chances are we get a good fair value gap that gets broken. Chances are you're at least going to be able to take some profit. These don't fail a lot if you use them right. Now, this happened to be in discount. It happened to sweep below. There's multiple other confluences that cause this to work. Okay, multiple other confluences that cause this to work. Don't look at the market in terms of IFVGs. Look at the market in terms of liquidity. Does it make sense to reverse here? Well, yes, because we swept. If you look to the left, we had equal lows here. So we just swept 3 equal lows that were just sitting here. Lots of stop losses under here. What does the market need to reverse? Stop losses. So the fact that we swept these, kind of build up or generate liquidity under here, tells me that it wouldn't be terrible if we did get a long setup to long here. And if this IFVG didn't form, let's say we kind of didn't form a fair value gap there, let's say the wick looked like this, I probably would not have taken the setup. But it would still make sense to pump here, and that's just based off of my knowledge of the market. Now, the nice thing is it happens to give us one, but sometimes that's not always going to be the case. So you just have to look at the market in terms of, like, does it make sense to bounce? Are we in discount? Are we in premium? What liquidity do we sweep? IFVGs are just an entry model. They will come second to everything else. And you need to understand everything else I teach in this in order to understand IFVGs and kind of that good entry model. So this is only a basic introduction to IFVGs. There's a couple more rules, there's a lot of signatures and price I'll post on my Twitter that are going to be good ones. If you want to learn more about IFVGs, I suggest buying my course. The link is in the description. It's a full lifetime fee. You get my course, and you can even watch 10 old live streams I've done, and I'll probably update that. Now, in my course, I also talk about daily bias and update and post some new daily bias videos, and I'll even make some predictions of what I think is going to happen for the week. It just depends. But I try to do 2 of those every couple weeks. And go over okay, here's the daily bias. Here's how I use my entry model, which is using IFVGs to enter based off my daily bias. So if you really, really want to learn IFVGs in depth, I would buy my course. I have about 100 slides alone that are specifically geared towards IFVGs and how to trade them. So if you want to get good at those, just, again, click the link in the description. If not, you're just going to have to experiment with these yourself because they will work, but a lot of people give up using these because they don't understand the broader picture of the market. They're literally just taking every single IFVG they see. Like, for example, someone will just take this one just randomly, and we bounce right after we close below it. Well, why wouldn't this make sense to take out this candle? Well, this candle sweeps so many lows. We've already swept all the targets that could have been the targets if we kind of fell below this, So, why would we keep going down if we just swept the low and we're just coming into another fair value gap? I mean, it's common sense at the end of the day, and you're going to learn this through screen time. So, a lot of new people might short this because, oh, we broke a fair value gap that was holding a lot, okay? It just, from common sense, it wouldn't be a good short because we've already swept too many lows at the same time they cannot close, and that's what people don't understand. And then we just get this really bad, choppy price action that's just probably wrecking everyone. So, again, if you want to study IFVGs or my strategy more advanced, I would definitely buy my course, but obviously it's up to you. Yeah, I don't want to do too much marketing here, but this is basically an introduction or whatever, on what they are and how to use them. And just remember, the biggest tip is look at the market in terms of liquidity, not IFVGs. IFVGs are just an entry model. Sometimes you might know where that market's going to go, but we might not get the IFVG to get there. We might get the bullish fair value gap to get there, but I fell in love with IFVGs. I'll not take a normal fair value gap anymore. I just can't. And that's going to be it for the video. See you guys later. Peace.